Hey everybody, welcome to the Peakhill Capital webinar. We'll get started here, maybe the next 30, 45 seconds and let people trickle in for a second. All right, looks like we've got the majority of the participants on. So welcome to the webinar. Thanks everybody for joining. I'm your host, Madison Russ, Vice President of Peakhill Capital. Joining you guys live from the great state of Texas in rainy Dallas today. I've got joined by three of our very own. We've got Harley Gold, President and CEO, also our fearless leader. He's based in Toronto. Sander Biderman, Managing Director, Co-founder of Peakhill Capital USA out of DC, and Kip Dunkelberger, our President of US Capital Markets, joining us from the underrated Midwest market of Minneapolis. We're excited to have everybody on today. Thank you for joining. We're going to chat about what we're seeing in the capital market space and also formally introduce the US to Peakhill Capital. We have invested in US real estate. We have lent on US real estate, and now we are formally expanding into the US with boots on the ground employees in specific markets to focus on our two US platforms, which is direct lending and capital markets advisory, which is the side that I sit on. Peakhill has a very strong presence across Canada already. Last year, we originated 5.3 billion in debt and equity, and we've done 20 billion since inception. And we'd like to replicate that success in the US. The goal is to do 6 billion in originations this year across all product types. And I think we can get there. We're entering a new stage of the cycle or a new cycle, depending how you want to look at it. And there is a lot of opportunity in the complexity of the market. There's a wall of loan maturities approaching, some of which have already hit. And I think that the days of extend and pretend or extend and amend are mostly behind us. And we want to work with commercial real estate owners, help them navigate this transition, reset, and thoughtfully structure their capital stacks moving forward. I think most of us, myself included, with my experience on the principal side, have seen firsthand how asset level operations really aren't enough to drive investment performance anymore. There are deals that are hitting pro forma, rent pro formas there. Expenses are in line with assumptions, but the deals aren't performing because they had floating rate debt or was highly levered with pref that's eating all the cash flow. So I really can't emphasize enough how thoughtfully structuring your capital stack moving forward is just as critical to investment performance as asset level operations. This is an overview of the debt landscape. I think I can understand how a lot of owners the last few years fell victim to their own capital stacks. The debt landscape is incredibly diverse and confusing and nuanced. And you really want to make sure you're working with somebody who understands the different buckets of capital. This is a pretty good visual on the different capital sources. Last year, the US originated over $1 trillion in debt, and this kind of breaks down the different pockets of each. So the majority of debt originations last year came from banks and credit unions, which makes sense from what we were seeing in the market. There was a lot of shorter duration refis that relied heavily on relational lendings, which is what regional banks are known for the most part. Debt funds are making a pretty big comeback. That's predominantly due because there's a big investor appetite to be in the private credit space. So these debt funds are able to get pretty competitive on pricing, and they're also known for having more transitional flexible capital, which is what a lot of borrowers needed last year. Agency typically dominates the stabilized multifamily lending world. But I would encourage everyone who is wanting to finance a multi-deal this year to at least get quotes from CMBS and Lifeco groups because they're getting pretty aggressive on their multi-platforms as well because they want to be in that product type. So that's very high level of the debt landscape. But again, it's very nuanced. So I think in this market, you need to work with somebody who's having those conversations every day with different capital sources to make sure that you're able to structure your capital stack and take a very holistic approach to it from both a debt and equity perspective. Um, to kick things off, Sander, I think, is going to give us a little bit of a rundown of what he's seeing in the market from a transitional asset perspective and maybe give a bit of a rundown of the Peakhill Capital Bridge platform.
All right, thanks, Madison. I appreciate the opportunity and appreciate everybody joining the panel today to listen to us speak. I'm going to focus on our bridge lending platform, which is centered on housing-related assets, including multifamily, student, and build-to-rent communities. At our core, we're providing transitional capital to existing assets that are temporarily underperforming or not yet ready for permanent financing. We generally see two primary situations where bridge capital is needed. First, there's light value add multifamily opportunities. These are existing assets that require targeted improvements to unlock value. The typical business plan includes interior renovations, might have some amenity upgrades or capital expenditures that are designed to improve occupancy or enhance tenant retention and even reduce long-term operating expenses. The second, we're seeing newly delivered assets that are in lease-up. These are typically higher quality developments that aren't yet achieving their projected lease-up velocity or the rent assumptions that were pro forma pre-construction. We're providing these sponsors with both time and flexibility to execute through the lease-up curve without forcing a premature exit or recapitalization. Peakhill's bridge lending program profile is that we typically lend on assets that range from $5 to $50 million, with our core focus in that $10 to $20 million range. That segment of the market has become increasingly underserved due to the pullback from regional community banks. Madison pointed out that they're sort of still the largest players in the market, but as a relative percentage of the market, it's come down quite a bit because of the Basel III retention and reserve requirements for the banks. So our loans are primarily non-recourse loans, other than standard carve-outs. Our underwriting standards are generally consistent with the agency execution through Fannie Mae or Freddie Mac. Our typical loan terms are 24 months with extension options, although we can structure shorter duration loans when appropriate, including 6 to 12-month loans. And our loans are generally floating rate, SOFR-based loans, interest only, with pricing in the low 300s, but we can be high 2s to upper 3s depending on some additional risk or LTV. How we think about risk on lease-up deals, we're realistic about the current supply pressures across many markets. We focus on assets that have the potential for long-term demand drivers and strong underlying locations. In the near term, success is more about managing concessions and tenant retention and operational execution, other than relying on aggressive rent growth assumptions. And over time, as new supply moderates, concessions we hope to burn off and expect to burn off, and leasing conditions should normalize. Our underwriting is based on a return of a more normalized market condition, driven by supply constraints rather than real short-term market optimism. So we're realistic about the markets. I have a couple case studies that I can just sort of high-level touch on. The first is a deal we did in Austin. That was a newly built property that was in late stages of lease-up. It was over 50% occupancy, and they were giving very large concessions away They needed time to both finish the leasing, but also really deal with the storm of new supply in the submarket. They were giving away 3 months concessions, and we're anticipating that over the next 12 to 24 months, they'll be able to retain a good share of their tenants and bring those concessions down to closer to 12 or 18 months, and our loan will ultimately refinance out or sell in sort of a 24 to 36-month window, depending on how quickly they're able to achieve their targeted sales price. A second case study is a deal we did in Washington, D.C. We provided capital to acquire a multifamily asset that was purchased vacant, and we gave them capital for the financing, but also future earnout dollars. They had vacant retail. They signed a lease with a drugstore, and we provided capital to fund the drugstore construction, leasing improvements, and commissions. So we gave them sort of the capital to do that. And we would expect that loan, now that it's fully stabilized, to exit to Fannie Mae or CMBS in the next 6 to 9 months. We also recently closed a value add loan in San Francisco that was more of a heavier lift. It was acquired 2C assets that were going to go under about a $15,000 a door renovation, and we provided the capital to acquire the property, and we're fully funding the renovation that should take 24 months for them to complete. So in summary, fundamentally, we're financing sound assets that simply aren't ready for permanent financing today because the business plan hasn't been fully executed. And our role is to provide liquidity, flexible capital solutions that allow our sponsors to complete the transaction and maximize long-term asset value.
That makes sense. Thank you. I've actually have a follow-up question, Sander. I've had a lot of borrowers come to me who already they had their bridge loan, it's maturing and it's not ready for permanent debt yet. What's the appetite for doing bridge to bridge product in this environment?
We're selectively open to doing bridge to bridge. I mean, we obviously want to make sure that the sponsors have good operational controls in place and are good owner operators. We see a lot of transactions where sponsors are really just suffering from higher interest rates and not poor management. So their business plan has proven out that if they do the capital improvements, they can achieve higher rents or expense efficiencies, but they need more time and more capital to complete the rest of the business plan. That's opposed to some of the other transactions where they've sort of failed on top line and bottom line and really just want a lifeline. And ultimately, many of those deals just don't fit because they're over leveraged, and without significant equity being put in, the loan to value doesn't make a lot of sense.
That makes sense. So it's situational, and I can send you bridge to bridge deals and you'll quote it if it makes sense.
Absolutely.
Love it. Okay, so that's good overview on the transitional asset market. Not all deals are actually doom and gloom right now. There are some assets out there that are stabilized and ready for permanent debt. Kip, can you give us an overview of what you're seeing on that side of the market?
Yeah, absolutely. Thanks, Madison. Yeah, coming from Minnesota, where everybody thinks it's cold all the time, today I think we're sunny and 87 degrees. So we're definitely feeling some of the same heat that you feel down in Texas from time to time. So today I was just going to touch on the more on the capital markets advisory side of things, and life insurance companies fall into that bucket. And historically, life insurance companies are fundamentally long-term balance sheet lenders. They're investing their premium capital and matching that with long-term duration liabilities with high-quality commercial real estate debt. So what does that really mean? So essentially, having that appetite creates a little bit of a different lending and investment philosophy. Generally, what they're going to do is they're always comparing investing money into commercial real estate whole loans, or can they invest their money into AA corporate bonds, and looking at the returns that they can get within the AA corporates with that risk strategy. And so as the markets continue to unfold throughout the year, their pricing can move throughout the year, and their appetite can also change throughout. Unlike the bridge product, where Sandor is going to be looking more at pro forma based underwriting. Life insurance companies are going to look at historical stabilized underwriting. So they're going to look more at the last 2 years and in-place income to be more indicative of how the property is going to perform going forward. I would say first and foremost, the life insurance company lenders are going to look at the quality and the location of the real estate. And second, they're going to look at sponsorship. And then lastly, they're going to look at structure of the particular deal that's being requested. Madison pulled up that pie chart earlier showing different buckets of money. And all of those different buckets of money kind of serve a different purpose and an appetite. Life insurance companies can range from life insurance will do deals, I would say, as low as probably 2.5 million. And some can run the whole gamut where they can go up to 35 million plus. There's some that are really just focused on that small market, some that are in the mid market. And then there's some life insurance companies that won't even look at a deal unless it's north of like 20 or 35 million. So why would you do a deal with a life company? What are some of the attributes, in doing business with a life company? Certainty of execution is probably one of the highest. When they put out a loan application, they've fully vetted the deal, and generally those loan applications turn into loan commitments. So before you even get started in the origination cycle, most of that is going to stay pretty static throughout the entire origination process. And that includes rate lock at application, flexible structuring, of the loan. Some loan products out there are pretty rigid that you really don't have much flexibility. It's kind of, take it or leave it. The documents are negotiable. They also are lower volatility throughout different market cycles. Even when we were in the liquidity crisis going back into that 2008 to 2012 time period, life insurance companies were still putting capital out into the market. They're very much a relationship-driven lender as well. If you get one deal done with a life company, there's a good chance you're going to go back and want to do another deal with them as well. I would say that they're not necessarily the high leverage lender. Generally, life companies will go up to about a 75% loan to value, loan to purchase price, and that's going to be on their underwriting. And what else can I tell you about life companies? Generally, they're going to be non-recourse, covenant light. I think that's probably a big one that differentiates from, say, the bank lenders, is that with a life insurance company, as long as you're paying your mortgage payment, if the building happened to go completely dark, as long as you can continue to pay on it, they're going to pretty much leave you alone on that. And a lot of that stuff is structured up front, but there's not going to be any like quarterly borrowing base tests or mark-to-market provisions or extensive financial covenants or anything like that as well.
Another thing on the Lifeco side that I've noticed, Kip, is that a lot of these groups have an equity platform as well, and sometimes they'll play in both sides of the cap stack. So I think that's been helpful with some of these smaller Lifeco groups. I think there's a bit of a misconception in the market that Lifecos are really only like a MetLife, New York Life, PGIM, but it sounds like there's smaller groups out there that are more like family offices, and they'll do smaller loan sizes, like $2 million, $5 million loans.
Yeah, absolutely. There's some, matter of fact, they do close to 3 billion a year, and the average loan size is probably 6 million. And so they're putting out a lot of capital that are, in that 6 million average, going down to probably 2.5 million, and they can go higher as well. So they do have a broad appetite.
Yeah, that's helpful context. Harley, why don't you give us a little bit of rundown of the other permanent debt product, which is CMBS?
Yeah, sure. So just to let people know, you can type a chat message if you want to ask any questions. So do encourage, I think we have 120 people online right now. So do send in some questions that we'll answer towards the end, or we can answer as we go, anything you like. And so in terms of, as we're talking on the bridge product, part of the extension of bridge is moving over to term. So a couple of deals Sandra showed you, San Francisco and the Washington, D.C. deal might be deals that actually don't go agency, and they might actually go CMBS, given potential debt yields on those deals. And also there's a commercial component on the deal in DC that has a large component of income there. So yeah, certainly we're seeing CMBS grow quite a bit right now. We've been active quoting deals and funding some deals. We'll announce quite shortly, and very active. And we would like to do a couple billion a year of CMBS program that's in-house here. And we originate, service the loans throughout the life of the loan, which is really important for CMBS loan, is that somebody works with a lender that also services the loan, as there are things that come up during the life of a loan that you want to deal with that sometimes historically have been frictions with the CMBS world, as well as it is quite important that a CMBS lender is reliable to fund on time and as the application was sent out. And there are some CMBS lenders out there where are acting as investment bankers and placing the B notes and the B piece, buyers and so forth. And there can be quite a lot of movement between, quoting a deal or soft quoting a deal to actually funding a deal. And so for us and our clientele, it's really important that we have a product that delivers what it says. So whatever the pricing is, we deliver on that pricing. Whatever the loan amount is, we deliver on that loan amount. And so that's utmost important to us, where in some cases we might actually not be the most aggressive quote because we in some cases could be the B piece buyer. And so we have the knowledge of what we want to close on. And so I think it's really important when people are looking at CMBS lenders that, to negotiate 5 or 10 basis points is not really the most important thing. It's really who can close on time, who do you trust that's going to be there to fund your loan, and that's really important to us in our underwriting and how we look at deals. Sander, I would say, the debt yields that he's looking at could be 6.5 to 8 probably in his space. I think on the going in or stabilized basis, life companies generally debt yields are going to be 8 plus, probably 8 to 10. I would generally say they're obviously a lot more conservative, and so forth. CMBS, we're sort of looking at debt yields 7.25 on the low end to 9 depending on the product type. We are quoting multifamily, we are quoting office, industrial, retail, self-storage, and we're quoting deals throughout the country, all different loan sizes. And you can see the spreads that we have there. Multifamily is obviously on the lower side. Office would be on the upper side, and then obviously you have hospitality as well. But CMBS is a pretty good place to be right now if you're looking for 5 or 10 year IO money. You can structure IO where a life company generally would not do a 5 or 10 year IO deal at that type of leverage. So there is a place to play. If someone doesn't want to work with an agency lender, CMBS could have a good place to fit as well. And there are ways you could do earnouts as well and different structures within CMBS today that you might not have been able to do in the past. But it's a great marketplace for long-term holders, I would say. I mean, obviously the product has a little more rigidity to it than a life company would. But if you're a long-term holder or you're acquiring properties, it's the market's back in action right now than it was at historical levels. We talked about the pie chart before. CMBS numbers have doubled and tripled of that pie chart that you saw on one of the earlier slides, as well as you saw the private lending bridge space has also quite grown, whereas the bank lending, has sort of moved smaller pie. The agencies have sort of stayed stable, and life companies have stayed stable as well. But I would say most of the bridge and most of the CMBS financing has really been picked up, taken away from the banks typically. And so we've seen a lot of movement into that space. And yeah, I think that's it. But all asset types, debt yields are different. Quotes only take a few days to put together, and so forth. But it is important when we do get, we do have borrowers on here, we do have brokers on here, and even some other lenders on here I see. But it is important when people are sending in deals to us, whether it's bridge or CMBS or even sizing for life company, that we get good information, right? Good information on the sponsorship, good information on the business plan, good trailing 12, trailing 3 months, in some cases if they're lease up. But getting that information up front is really helpful to really making a good decision on what you can do. And so we don't have a lot of questions later. And so that's really important to moving efficiently through financing.
That
we
makes
like to
sense.
do.
Have you had any borrowers come to you? The assets are ready for permanent debt, but they don't necessarily want to lock in long-term rates right now because of the spike in the treasuries. I know it's come down a little bit. Have you been able to come up with any sort of creative solutions for them there?
Yeah, so like I mean that's great for us because like we're happy to do a bridge loan for 3 months, 6 months, 9 months that qualifies for CMBS or qualifies for agency or qualifies for life company. So we're a bit unique because we're a newer lender. We're actually okay with shorter maturities. We're okay to do open loans, and so we'd actually be open to those opportunities where typically another lender is going to want a lockout period. they might do a 2-year loan, but they want to be locked out for a year or 18 months. We're okay to do almost a fully open loan. So we'd be interested in that kind of business. And then also in terms of fees, we could roll fees like we may not have to charge like two fees. If it's like one loan, we could look at it almost like one loan. If we're doing a bridge loan, we're doing a CMBS, we could apply that fee towards that. So there's a benefit in that. And there's also lower legal cost in doing that as well for the borrower. If we know upfront that we're sort of structuring a bridge and then moving it to CMBS or even life company financing.
Okay, so you could structure
Yeah,
a pretty flexible bridge. Oh, go ahead, Kip.
Yeah, I was just going to mention that, the life company side, what we've seen is that life companies traditionally have been like 10-year fixed rate lenders or longer. And more recently, we've seen many of them get creative with 5-year money. So they're lending over the 5-year treasury. And some of those smaller, I shouldn't say necessarily smaller, but some of those are doing the smaller deals. They can go down to terms as short as 3 years, and they can do like a 3+3 or a 4+4, and they can do rate resets in there. So life insurance company has started to play into some of that space on shorter money, not necessarily, to the extent that Harley was talking about with some of the bridge stuff, but at least shorter than 10 years. They'll get 5 years and less in some cases. And we do have a couple of our life companies that are doing some float to fix stuff as well.
Yeah, there's a lot of product out there. I think that echoes my sentiment earlier for all the borrowers that are listening. There's a lot out there. It can be a little overwhelming. It's important to work with somebody to make sure somebody who's having these conversations every day with different lenders and their different products to make sure that you know what your options are when you're financing a deal. We are running out of time. It was a quick 30-minute webinar today. But to wrap things up, maybe I just do a quick rapid fire of if you guys were buying a deal in the next 30 to 60 days, would you fix it or would you float it? Start with you, Harley.
Yeah, I would fix. I mean, I think, look, real estate is a long-term business. I think a lot of people have learned their lessons floating over the last few years. And if you're buying an asset or you have an asset, you should be looking to hold it 5 or 10 years, and you should be looking to fix your debt. That's the safest and best thing to do, and so forth. So yeah, I would say fix.
The risk-averse approach. Sander, what about you?
As the floating rate guy, I'm going to have to still agree with Harley here. The margins are so tight on commercial real estate that taking the speculation out of it and fixing your interest rate makes the most sense. I've yet to meet the real estate developer that made their money on gambling on interest rates. As a bridge lender, we're really providing money for business plan execution, not sort of guessing which way rates are going to go, but more, like I said, the value add component. So our goal is that when our customers complete their business plan, that they convert to fix as well. So I'm supportive of fixing rates if the numbers make sense.
Yeah, I guess I'm going to probably align with the rest on this one. The philosophy is if the deal works at whatever your interest rate is today, in 5 years from today, it's probably going to still work at that same rate. So, take the risk off the table.
I like it. We're all a bunch of risk-averse lenders. I don't know if we all would have said the same thing in 2021, though. That's okay. Well, we are out of time today. Thank you, everybody, for joining. Please reach out, email us, message us on LinkedIn. We'll host an event in Dallas and different cities here soon. But thanks, everybody, for joining, and have a great week.